switching on to the big story this hour, well, in news which is likely to elicit a mixed response, the weekly jobless claims in the United States have come in at a two-month low of 228,000 for the week that ended July 15th. Economist's poll by Reuters had forecast 242,000 claims for that week. The unexpected fall in jobless claims indicates a tighter labor market. Meanwhile, in more macro data-related news, a drop in inflation in June had made investors hopeful for some respite in the Fed's interest rate hike cycles. But just a while ago, the Fed Reserve had announced that another rate hike might be on the cards, might be in the works after the July meeting. So what can we expect now looking at the current jobless claims? What does it really indicate? To answer all of those questions, I'm now joined by Peter Cardillo, Chief Market Economist, Spartan Capital Securities, LLC. Peter, thank you very much for joining us this evening on ET Now.
Thank you for having me.
Right, Peter, so how do you see the latest jobs data? What is it telling us about labor markets?
You know, if you look at the drop by 13,000, that was a little bit more than we expected. But if you look at the continuous claims, they were up by 33,000. Obviously, that's a key to the job market in a sense that the job market is beginning to show some weakness. Of course, if this continues, we've been on a trend where they've been up 50,000, down 30,000, and back up 40,000. So, you know, we just have to wait and see for more evidence. But this is indicative that the job market is not as strong as it appears to be.
Right. And in fact, there was some bit of interest rate reprieve last month. But if this trend continues, what do you see the Fed doing? Hiking interest rates again?
Well, it's almost a foregone conclusion that the Fed is likely to raise by 25 basis points, although I'm in the camp where I think that might be a surprise and they may hold off. But nevertheless, the market is now priced in a hike of 25 basis points. And I think that, you know, they'll stay on course with the tough language. And they'll talk about inflation, bringing it down 2%. Of course, they know, just like the markets know, that that's not achievable anytime soon. And so I think, you know, we'll see the markets respond accordingly. But you have to also remember that the market has already priced in 25 basis points. And of course, if we get a surprise, then that would be, you know, a big surprise to the market. But I think there's a good chance that as we get close, that at the Jackson Hole meeting at the end of August, that they probably will be very clear on the fact that they are finished with their job of raising interest rates. So if it doesn't happen in July, which most likely it won't, it certainly can happen in September.
Right. So you mentioned the word surprise twice during this answer, but I'm going to go to the first instance when you use the word surprise. You said that the Fed could spring a surprise as far as an interest rate hike is concerned. What did you mean by that?
Well, what I mean is there's been enough evidence that you know, inflation certainly is coming down. It's going in the right direction. It's been cut more than 50% here in the United States based on a year-to-year outlook. And so I said surprise twice because I'm saying that it would be a surprise to the market if the Fed decided to talk tough, but yet stay on hold like they did in June. Now, the market is built in a 25 basis point hike. So if we do get that surprise, it would be a big surprise to the market.
Right. So you say that the market has already factored in a 25 basis points hike. But moving on, and perhaps to my last question, some economists are predicting that payrolls will turn negative in the second half of the year, a development which they say would compel the Fed to start cutting rates to avoid plunging the economy into a deep recession. What's your take on that?
Well, I've been calling for a mild recession. The market now seems to be thinking that the Feds can avoid a recession and head for a soft landing. When I say the market, I mean several noted economists. The market itself, if you look at the yield curve, continues to indicate that we're headed for recession. Now, is recession avoidable this year? Most likely, but can we avoid it in the first quarter of 2024? I don't think so, unless the yield curve flattens, to the point where we get back to normality. Then, and of course, if we don't see the economy being choked off by the consumer, then that we will be proven wrong, and a soft landing is possible. But I don't think so, because again, if you look at the macro news, you'll see that the economy is being supported by the consumer, and if rates continue to move higher, the consumer is not going to be able to support the economy, and so we will catch up with that half of the economy that's in recession. And again, look at the Philadelphia manufacturing index, which dropped 13 points, basically almost like the previous month. So that's an indication that the manufacturing sector is in recession.
All right, Peter, thank you very much for joining us this evening on ET Now. So that's the word coming in from Peter Cardillo, who's the chief market economist, Spartan Capital Securities, that the markets continue to indicate a recession, even though it could be a softer landing.